Hi, everybody. My name is Richard.lesperance. I go by the name of my man Richard. Welcome to A Better Lifestyle. Today, I have the pleasure to have Michael Matthew with me. Michael is a CPA and a real estate investor, and we're going to be talking about investing in the real estate market, but in the US for Canadian investors. So, please, Michael, tell the audience a little bit about yourself and how did you get started in the whole game of real estate?
Well, first of all, thanks for inviting me, Richard. And I really got started in the real estate investing a little over a decade ago. And I started going to these conferences in the US that appealed to both business owners and real estate investors. And as I went to these conferences, I realized I needed to pick a way for me to get involved in it that made the most sense. And talking to people, I realized that one of the big areas of weakness, I would say, is people didn't know how to set themselves up to invest in the US as a Canadian, and they didn't really understand anything about the taxes. And as a CPA, I deal with taxes on a daily basis, and I set about learning how I could help people with that and also with setting themselves up, creating corporations and that sort of thing. And I spoke to people who'd already started investing in the US to find out how they did things. And they would tell me. And I quickly determined that it came down to one of two things. They set themselves up the same way the last person they spoke to did, or they set themselves up the same way the first person they spoke to did. Problem was, I knew those same people that they were relying upon for their advice, and they didn't know what they were doing either. That led me to digging into the topic, and over a number of years, I came to understand it more and more to the point where now I advise clients on how to do exactly that, set up to do business in the US in terms of real estate investing and handle all their taxes.
So what should the Canadians look for when what are some stuff that they should have to pay attention to when it comes to real estate investing in the US?
The number one thing is to decide where you should invest. And to me, that comes down to, is the state in question a landlord-friendly state or a tenant-friendly state? And it makes a huge difference. As an example, where I am in Ontario, it can take 6 months to a year just to get a hearing to kick out a tenant who hasn't paid the rent during that whole time. I was on a call with someone from Texas, and they were apologizing for the fact it took 3 weeks to get the eviction process started when someone doesn't pay. So it's a dramatic difference. And when you're looking at states like New York, New Jersey, California, it's much the same as it is in Ontario, in that it can take a year or more just to get out a non-paying tenant. So that's the number one thing, is to look at that. Then you want to look at a place where the population is growing and why it's growing. So Florida is a very popular place for Canadians to invest. And in the town that you're investing in, there may be a lot of retirees. If you're catering to that market, it's a great place to invest. But if your target market is more young families, it may not be the best place for you to invest. So you need to dig in a little bit past that population growth to find out why it's growing.
You mentioned Florida. For people we know, like they have hurricanes and all that. So how would they know where to invest so they're not affected by that?
Yeah, that's a great point. Weather can turn a good investment into just a horror show if you're not set up properly and if you don't have insurance against such things. You just need to look at the historic weather patterns. For instance, Orlando is more or less in the middle of the state, and it tends to, as a result, get far less of those severe weather systems that you can get on mainly the Atlantic side, but also sometimes on the Gulf side. So just look into it a little bit. And this is where speaking to people with local knowledge can be very helpful. And there are many real estate groups out there that you can join on Facebook and Meetup and so on that can give you some actual on the ground historical perspectives of investors who are already in the market that you're looking at.
You mentioned Florida. What are some other places that people can invest in the States? Good places.
Very popular states are the Carolinas, so North, South Carolina, Georgia, obviously, as I mentioned, Florida. Texas is very popular, Nevada, Arizona. Basically, you're looking for places that are led by Republicans, it seems, because those are the ones that are not going to punish you as a landlord. And you're not looking for an uneven playing field in your favor. You just want a fair shot. And it seems like it's those so-called red states that are able to give you that. And it's just also related to geography, right? The trend has been for people to move south for better weather, and that is going to be those most southern states like we just talked about.
What are some places to avoid?
Definitely you want to avoid California, New Jersey, and New York. They have very high state taxes, double digits, and they also have that extreme bias towards tenants that can really, really hurt you if you run into a bad tenant. And it happens. I have an investment condo in the Toronto area, and the first two tenants were dream tenants, never an issue. And I thought, boy, this landlord stuff is easy. Then the third tenant came along and they had a cockroach infestation. And it took many months of sprays and trying to convince them to do a better job. Eventually, I convinced them to move out. But at that point, I had to consider, do I just want to sell and never rent again? Because it was such an effort to get them out. And luckily for me, they didn't dig in their heels and refuse to leave, because had they done so, I would have been stuck in that same system of, waiting up to a year to get a hearing at the landlord tenant board to get them out of there. And even if you get that, it's going to be several months before they're out. So it could be as much as a year and a half. In the meantime, you're often not getting any rent paid at all. I was very lucky in my case, they paid the rent, but having yourself stuck in a situation where all the all the law is on their side makes it very, very difficult and obviously very costly financially.
So for people who are they might be beginners or they're they've been in the real estate for a while. Some people might want to invest in single family homes or multifamily homes. So what would be like their approach in regards to those two asset classes?
That is where people start. They tend to start with single family homes or perhaps a two, three, four unit. And it's much the same process for both. The only difference that comes out is when you get into larger units. So that would be re- 5 units and above buildings. That's when you get into what's called commercial loans and so on. And the rules are different. Once you get above that four number, you're into a situation where it's not so much your assets and your credit history as an individual. It's about whether the building itself will generate sufficient income to cover your loan payments. So that's the major cutoff and difference. Beyond that, it's just a question of finding a suitable property and setting up a team because obviously when you're investing remotely, you're not going to be doing the maintenance and all this sort of stuff yourself. You need to plug into a team. And what I like to do is just ask fellow investors who have already invested in the market I'm looking at who they work with. And that's a really good place to start. And you'll find that good people know good people, right? So if you get a good property manager, part of what makes them good is they'll know good contractors. So they'll know a plumber, an electrician, et cetera, that they'll need to bring in for larger jobs. And that's a great benefit because you realize you don't have to come up with all these contacts yourself.
When it comes to financing, do Canadians have special options? Because I know there's the Fannie Mae and all that in the States. So how does it work for Canadians?
Yeah, it's a little bit different for Canadians. The traditional method, of course, works. You bring down cash, and that could be cash from a home equity loan you've taken out on your existing property in Canada. But there are, in fact, several companies now that cater exclusively to non-resident investors. In other words, if you're a US resident, you cannot get a loan with them, and they will finance your purchase. It's going to be a little bit higher than perhaps Canadians are used to, but it's a way to get started. And these services are often completely online, so it's very seamless to get in touch with them and get your approvals and so on. And once you have that first property, of course, you now will have US assets and you will be able potentially, as you improve that property, bring up the value to take a traditional loan from a US bank and get a better rate. Because the local bank will always give you a better rate. There's no question about it. It's just that without any US assets, it's difficult, or credit history for that matter, it's very difficult for Canadians to get a loan from that traditional local bank.
One of the thing that is essential is that the numbers make sense when if you want to do these kind of investments. So talk to us about that.
Absolutely. Beyond looking for a property in a landlord-friendly state with growing population that suits your model, you have to run the numbers. And what I do is through my various real estate coaches, I've acquired a spreadsheet that essentially goes through all the costs of purchase and all the operating costs and the expected income. So how do you figure those things out? Well, you need to ask the seller for that information. And typically you'll ask for the last couple of years of financial results in whatever format they have it, tax returns, financial statements. And you always want to make sure that you get what's called a T minus 12 report, which is showing you what's actually happened in the last 12 months because economic conditions can change. Obviously, we've seen a lot of variability in interest rates over the last couple of years, and you want to make sure that whatever you're buying in terms of the tenant profile is actually something you can rely on because having a listing of the rents per unit is great, but you also need to know if the tenants have actually paid that. So you need to know if there's any late rent, outstanding rent, that sort of thing. And that's what that T minus 12 or T12 report will give you. So you basically get into the numbers. You'll ask for utility bills, electricity, heating source, whatever it is, gas or oil, what have you. And the seller is the one who's going to provide you with that information. And you're going to need to know, obviously, the legal fees and so on. And just by talking to fellow investors, you'll get a pretty good handle on that as well. So once you have all those numbers, you put them into a spreadsheet and you see what your return is. And you want a situation where you're getting a minimum return, whatever your minimum is. Some people say, I want 5 or 6% cash on cash return as an example. Anything below that, it's just too tight for those numbers to actually be relied upon. So what I'm saying is, if the only way this can be profitable for you is everything goes right, every tenant pays in full on time every month, there are no repairs, utility costs stay exactly where they are, and then you eke out a small profit. Obviously, that's not a good investment because there's just not room for reality to come in and have those numbers change. So you need to leave yourself a buffer, essentially.
So when it comes to structuring these kind of investments, whether it's for a single family or multifamily, how should what's the structure for that for Canadians?
I think all or virtually all of the clients I've worked with have adopted a similar structure. They're investing with themselves or just say one investment partner. And their plan is to leave the profit in the US to build up over time so they can invest in a second property and a third property and so on. And so, given the litigious nature of the US market, especially, I always recommend that you have a corporate structure taking title for your real estate. You don't want your personal assets to be at risk here in Canada because someone slipped and fell on your property and sued you for not maintaining it. As a result, I'll just use an example of an Ontario investor. They would set up an Ontario corporation that then owns a Wyoming C corporation. And then that owns an LLC in the state of investment. So we'll say Florida. So it owns the Florida LLC. The Florida LLC is the one that takes title. And by having a US entity owner, i.e., this Wyoming C corporation, it allows you to use the LLC the way 90% plus of Americans do and other investors, which is it's called a flow through or disregarded entity, which means all the income and expenses of that Florida LLC in this case will flow through to the Wyoming C Corporation, which means that's the one that files the tax return. You could have 3 properties in each of 10 LLCs in 10 different states, so 30 properties. All of that would flow through to just one Wyoming corporation. And the reason for that is if you have direct ownership of an LLC as a Canadian resident, it results in double taxation, which you don't obviously do not want. And it's simply because CRA doesn't know what a flow-through entity is. It's simply a corporation as far as they're concerned. And so whatever tax you pay at the corporate level in the US is not deductible on your Canadian individual tax return. And that's why you can never own it directly. And this allows you to isolate the liability to that one LLC for that property or properties. And people then ask, well, how many properties can I have in one LLC? That's up to you. I can give you an idea of what it will cost to open up a new LLC and maintain it. But what I cannot do is give you a valuation of your peace of mind by having things isolated or grouped together. So some people say, look, it's going to be complicated. I don't want all this extra filings. So I'll put everything in one LLC. Other people say, well, I had trouble in the past and everything was at risk because of one property. I want to separate each one into its own LLC, even though that's going to cost them more money, no question about it, at least in the short run. Realistically, most people will pick something in the middle. They'll arrive at a valuation of, let's say, 500,000 or $1 million. And as soon as their property's value exceed that, they open up a new LLC. And it's important to understand that you don't have to open up an LLC in every state just because you're investing there. So in my example, the Florida LLC can absolutely operate in Georgia, which is its neighbor. It just has to pay a one-time registration fee to do business in Georgia, and then it would operate just the same as if all the investments were in Florida.
When it comes to the financing, I wanted to go back on that. What about the credit history of the individual? Or is there a way to work that out? Like if they're going, whether it's a single family, I know for the most part, single family is based on your personal credit, but the multifamily is based on the cash flow of the property. So how does it work?
Yeah, that's right. Up to 1 to 4 units in a building, that is primarily reliant upon your personal credit history. And above that, it's primarily related to the ability of the building itself to carry it. What you'll find is that while the local banks, regional banks, they are very much focused on credit history, and it has to be US credit history, of course. These online lenders, these secondary lenders are not, because the reason they exist is to fill a need in the market, which is investors who could be multimillionaires outside of the US but have no US assets. They often have a difficult time getting a mortgage from a traditional lender like the local bank. So they will take that into consideration. And as long as your credit history isn't absolutely horrible, they'll often just accept that as a sufficient proxy for them to do what they need to do. Now, you will often pay a little bit higher interest rate for these other services, but that's because they know you can't get that local financing. So it is there, it is available, and you just need to factor in the actual borrowing costs into that spreadsheet we talked about earlier to make sure that this deal that you're looking at will be able to cover everything that you're looking to cover and plus give you the profit that you're after.
Mhm. I want to touch a little bit about two more questions. Risk management. How does someone deal with that?
It starts by doing your homework. We talked about it, putting everything into a spreadsheet to make sure the numbers work. So that's obviously important. You also need to take the same steps you would for a local investment, which is you have a home you're looking to buy, you need to get a property inspector in there. And when my partner and I were looking to invest in Ohio, we had 5 homes that we were looking at. It was owned by an investor, ironically enough, lived about an hour away from us in Toronto. And the first thing we did was get in touch with a property inspector in the area. And he went out and looked at the property. And just by the external photographs that we had access to, we picked what we looked at as the one in the poorest shape. Our property inspector went out there and he found out that the property manager was essentially lying to the tenants about who is responsible for what repairs, which is obviously not a great sign at all. And that the slope of the property was such that rather than it being graded to drain away from the house, everything was sloped into the house, which means anytime there was rain, it was being directed towards the walls of the house, which greatly increased the potential for basement leaks, and those can be very expensive to repair. So I think we paid $350 for that inspection, but it saved us potentially tens of thousands of dollars in unanticipated repair bills, which obviously would have wiped out all our potential profit on this deal and made it a huge money pit. So you do your homework, you run the numbers, you get the property inspected, you get competent management in place, and the best way to do that is to get referrals from other people because they are the ones who have the actual experience with that individual. It wasn't in the US, but I have a client who had a property manager who kept telling them that unfortunately I just couldn't rent the place out. It's just sitting there empty, but I'm looking, I'm looking. Eventually they decided to drive the 10 hours or so to where this property was located, only to find out there was a tenant. They've been there for, I think, at least 6 months, and they've been paying cash to the property manager. So obviously that guy was fired immediately, but their problem was they didn't get sufficient references to this person in the first place.